Hello, welcome back. The second half of our lecture will focus on the efficient market hypothesis. So let's jump in. What's the big idea? Within the market, we have all types of investors. We have some investors that are informed, meaning that they have some information that we think they'll trade on. And we have investors that aren't informed or uninformed. And those investors might not be trading on any specific piece of information, but they might just enjoy trading, or they might have liquidity needs or different reasons for trading. So what happens? With enough competition amongst these informed investors, as they compete to buy underpriced stocks or sell overpriced stocks, that competition is going to push prices to do two things. First, to react quickly to information, and second, to reflect fair values, to always reflect their fair values. So within an efficient market, we would expect prices to react quickly and correctly. For example, Jim Cramer's stock picks on Mad Money are based on information that's already publicly available. So if the market already knows this information, we would expect it to already be incorporated into stock prices. So we should not expect that in an efficient market, his stock picks would have any value. And we also would not expect prices to react to his stock picks because, again, this is all publicly available information. What do we see when we look in the real world? In the real world, when we take a look, we find that Jim Cramer's stock picks have significant effects on stock prices. We can observe that the prices are reacting very quickly, and they seem to be incorporating information that's already publicly available. So this is a violation of our efficient market hypothesis. We can think of the efficient market hypothesis as coming in three forms. There's the weak form, in which all past information is incorporated into stock prices. This means past price, past return information, all of it should already be incorporated into your stock price. You can think of it as me having a graph of where the prices were a year ago or where the price was yesterday. Shouldn't really tell me anything. There's semi-strong form. So now we're not only incorporating all past information, but we're incorporating public information. So all past information and public info is incorporated into stock prices. This means that even if I read a newspaper and I see that a firm is engaging in some new investment or a company is acquiring another company, by the time that information is in the paper, it's already reflected in the stock price, because once this information becomes public, instantaneously the market reacts to it. And then the third type is the strongest type, strong form efficiency. We have all public, all past, and now private. So no public or private information can be used to make abnormally high returns. So these are the three forms of market efficiency. What are the implications of this efficiency? Well, a first implication is that stock picking and market timing should add no value. That means that if I have an actively managed mutual fund, if my fund manager is picking stocks for the portfolio in timing when we should enter or exit the market, it should not add any value if the market is efficient. It also means that we shouldn't be buying or selling based on the arrival of news, because by the time we've heard of it, that price has already been adjusted. The price has already incorporated the news that we're trying to trade on. So we don't really earn any abnormal return by trading on this news. And the last implication is that a corporation should accept all positive NPV projects if they can. Why? Because once they announce this NPV of the project, it will quickly become incorporated into the stock price. So any positive NPV project you can engage in will quickly become reflected into the stock price. Now, there are violations of this efficient market hypothesis, and these violations we refer to as anomalies. An anomaly is a term that you've probably seen before, and it kind of means something that's unusual or something that you really don't think should exist. The reason why these are called anomalies is because we'll have ways of earning significant abnormal return relative to the market, which should control for all of our risks. So what are some of these anomalies? The first anomaly is small minus big. Small stocks have outperformed big stocks by around 3.5% on an annual basis since 1926. Our second anomaly is going to be value minus growth. Oftentimes in valuation, you'll hear people refer to a market to book ratio or a book to market ratio. So let's take a look at value minus growth. The idea here is that firms that have a relatively low market to book value, so these are firms that have, let's say, a market cap of $10 per share and their book equity has a book value of $10 per share. That's different from like a growth stock. So you can think of a growth stock as like a tech firm. A tech firm might have a book equity value of, let's stick with $10 per share, but a market value of $100 per share. So with a value stock, the market is saying, I really don't expect there to be a lot of growth in the firm. So I'm only really going to pay something close to the book value of this firm, versus a growth stock in which the market expects there to be a lot of growth in the firm. So you're willing to pay a much higher market value than the book value of the firm. Why does any of that matter? It matters because when you look at value versus growth, if you form a portfolio of value stocks minus growth stocks, you will find that they consistently outperform. Value stocks have an abnormal return above growth stocks of around 5% since 1926. This is a total violation of our efficient market hypothesis because it shouldn't matter. This is all past information. You know what the firm's book value is and what the firm's market value is. Those are publicly available pieces of information. The last two anomalies have to do with momentum. And momentum is just like it is in science. Things tend to continue in the direction in which they were going. Within finance, we kind of have two forms of momentum. The first is price momentum. Sometimes you'll see this referred to as winners minus losers or up minus down. If you look at stocks that have had high returns over the last 6 months, in the next 6 months, they tend to continue to have those positive returns. If you look at losing stocks, stocks that have had lower returns over the last 6 months, over the next 6 months, they tend to have lower returns. So the return behavior previously is strongly associated with the return behavior in the short run. That's a total violation of our efficient market hypothesis. It shouldn't matter where the price was before or where the price is. Where the price is today should have nothing to do with where the price was 6 months ago, but we don't really see that empirically. And our last anomaly is going to be earnings momentum. So in the paper that did this, they showed that if you sort stocks by both their price momentum and their earnings momentum, meaning that if we look at stocks that have just announced their earnings, there are going to be some stocks or some firms that have positive earning surprises, so they beat analyst expectations or they earn even higher earnings than they earned this time last year. And there are going to be firms that have negative earning surprises. These are firms that do not meet investors' expectations for the firm's earnings or have earned less than we expected them to based on their previous year. If you sort stocks based on the ones that have had positive earnings and you subtract or you short the ones that have had negative earnings, that portfolio is going to earn significant abnormal returns over a pretty lengthy trading window. So with all of these anomalies, we're finding ways in which we violate the efficient market hypothesis because we're using information that's publicly available and past information like the price momentum or like your earnings momentum, and it's highly reflective of future stock price performance. So these anomalies are violations of our efficient market hypothesis. So let's look at some questions. Which of the following are statements against weak form efficiency? Question A, stock prices tend to go up when interest rates decrease. That doesn't violate weak form efficiency. Why? Well, because that's publicly available information. All things held equal, we know when interest rates decrease that we're going to have a lower discount rate for all of these expected future cash flows. So it's not a surprise that stock prices go up when interest rates decrease. That's believable. B, many traders use technical analysis to decide when to buy or sell stocks. Technical analysis is essentially an investment tool of using graphs and trends to figure out past price movements, to figure out if that has any implication for future price movements. And it's really closely related to momentum. So we can kind of see how that's a violation of weak form efficiency. If I'm a trader and I'm using technical analysis, i.e., I'm using past stock price performance to have an investment strategy about future stock price performance, that violates weak form efficiency because all of that information should already be incorporated into the stock price. Question C. Once a stock has earned positive abnormal returns for 2 straight weeks, the price is likely to continue going up the following week. Also a violation of our efficient market hypothesis, a violation of weak form efficiency. Why? Well, it's the same reason. Whatever past return performance or past price performance that we observe, all of that is information that's already available. So it shouldn't be used to predict where the market will go. Question D. In January, stocks tend to have higher returns than in December. This is called the January effect, and it's a puzzle that we've had in finance for many, many decades. This is also a violation of the efficient market hypothesis. It's a violation against weak form efficiency. Why? Well, January is a month. We know the months. That's all publicly available information. There is nothing about that that we shouldn't be able to identify and to already incorporate into our stock price. But we still have this puzzle. So our next lecture is going to focus on the cost of capital. We're going to apply the CAPM, and we're going to use that to estimate the weighted average cost of capital, or the WACC. Where are we headed? After we apply the CAPM, we'll get into forecasting cash flows, and then we'll look at financial and real options. A good chapter to read in preparation of our next lecture will be chapter 9 that focuses on the cost of capital. Thank you.